Welcome to TheoTrade. This is Don Kaufman. It's December 27th, 2019, and you are watching the TheoTrade Weekend Update. Markets have gone too far. Now, I know that sounds like I'm going to have a massive bearish tilt to the marketplace, but in this discussion here, and this idea, if you will, of markets have simply gone too far, has absolutely unequivocally nothing to do with directional bias, which will be explained here momentarily. What we're really going to be discussing in this weekend's update, okay, is a critical juncture of the efficiency trade, which again, I will explain here momentarily. With that, Happy New Year to all. Listen, this next week of trade, we're still looking at 4 trading sessions. Monday is a full trading session, okay? Tuesday is a full trading session. Yes, I know it's New Year's Eve, but it's still a full trading session. We'll be off on Wednesday. We come back to work, of course, on Thursday or Friday. And the markets are even anticipating, people, a little bit of volatility. Let's get down to business again, explaining what I'm really referencing when I'm talking about markets have gone too far. Because when you do hear that, you're like, it's got to be talking about this rally. But we're not. To begin with, we're going to look at the SPX and the expected move, okay, in this past week of trade, which people, once again, the expected move has been absolutely unequivocally spot on. We said, okay, over the weekend that we expected about a $28 and change move because that's what the market anticipated. And we reiterated that on a Monday night video. And if you zoom in, all right, to trade this week and trade this past week, this held what, 3.5 trading sessions. And again, I want to just kind of detail this for a moment. Here you had, again, $28 move higher, okay, or $28 move lower. The first 2 trading sessions, in fact, Tuesday held a half a trading session. We did absolutely massively nothing, okay. It all basically happened effectively, day after Christmas, we broke to the upside. Of course, today, in today's trading session, we got, again, within just a few pennies. In fact, you even have to bring this to intraday trade, just a few pennies within the edge of the expected move. So once again, okay, we are inside the edge of the expected move. Now, one of the first points that I want to make over here is simply that if you look at this last week of trade, the markets really weren't anticipating much. Again, $28 a movement. We got every ounce of $28 a movement. But this next week, it's a similar kind of holiday week of trade. Yeah, not so fast there, cowboy, because you've got a whole lot of extra volatility packed in there. Listen, we're still looking now for back to a $35 and change move, which does mean, hey, okay, get ready to rumble. It doesn't matter what you might think about the holiday week of trade. Coming out after the first of the year, January 2nd, hey, traders come out swinging. It's a brave new year where trade and money gets put to work. But we're going to push that aside for just a moment. So again, we say anticipate a little bit more volatility, of course, next week. The next thing, okay, and this is going to lend itself very much to how markets have actually gone too far. We are now moving into, okay, 21 weeks, people, without a major breach of expected move. Now, this begins our discussion, of course, of what we often term the efficiency trade. The efficiency trade, okay, is all about, and I'm going to give you a couple of examples on this momentarily, but it's all about not just being inside an expected move. And again, I want to elaborate upon this for just a second, okay? Let's use the coming week of trade. This coming week of trade, as I said a moment ago, what are we looking for in here? It's about a $35 move higher or $35 move lower. Now, that's not a number that I'm pulling out of thin air, okay? The $35 move higher or lower pretty much defines what the marketplace is highly likely to move. It comes from, well, right here. Right here happens to be, okay, this is the thinkorswim trade tab, and over to the right-hand side in the options chain, that's your expected move, $35 higher or lower. And that expected move is derived from option pricing, okay? So in the end, the $35, okay, and I'm going to close up this left side bar, that $35 is based solely on the option premiums. Okay, that's it. Now, you can look at this in a number of different ways. If you look where the market's currently trading, it was 32.40. Okay, if you added, all right, the 32.40, what? You know, puts over here to the 32.40, for instance, calls, what do you got? It's about a $30 expected move. All right, so in this case, you're like looking at, this is what they call an at the money straddle. How come this is 30 bucks and over here you have $35? Because the expected move calculation that's done on thinkorswim also takes into account skew. For those of you that know what skew is, out of the money puts carry a little extra premium. That extra premium is actually packed into the equation of expected move. That's why sometimes the at the money straddle doesn't necessarily dictate precisely the expected move. Okay, but the bottom line is right now there are literally billions of dollars, okay, being traded on the idea that we're going to move $35 higher or lower. It's like setting the line in a game. And I've explained this, you know, in numerous times over here. I mean, look, today, it's a slow holiday trading session, but we've still done 1.2 million contracts inside of the SPX. Okay, what the efficiency trade is really about. Okay, if you have enough traders, all right, using these expected moves, and again, now I'm going to actually jump to last week's. So we're expecting this past week a $28 move. Right? Now, there are traders that go out there and they sell that $28 move. And there are traders that go out there and have to be on the other side, the buy side. You have to remember, in this business, for every buyer, there is absolutely unequivocally a seller. That's what the options market's all about. Well, yeah, and if there's an enormous number of buyers and sellers, it'll actually draw the marketplace literally to the edge of the line being the expected move. Why do you think we moved $28 this past week of trade? And you're like, okay, I get it, but that's only 1 week, really? Because now for the last 21 weeks, we've been inside the expected move. And the number of times that we're actually drawing to an edge of an expected move is getting completely and totally out of control. It's too far, okay? We have gone far too efficient. And that's the point that I want to reiterate. And I'm going to explain, okay, the damage that can be done. Look at this. Edge of expected move, edge of expected move. Here, we're just shy of the edge of expected move. Sure, we pulled in towards the close, okay? Here's a week where we missed it. Great. Here's a week we ended up on the edge of the expected move. Okay, here's a week on the edge of the expected move. Here's a week on the edge of the expected move. Here's a week within what? Okay, a rounding error, the edge of the expected move. Here's a week that we ended on the edge of the expected move. Need I continue? Okay, in the last, 15 to 20 weeks, okay, you've got 1, 2, 3, 4, 5, 6, 7, 8 weeks, okay, that aren't just inside the expected move. They're on it, people. Okay, the efficiency has gone simply too far. Okay, what that effectively means, there's nothing. There's no edge between the buyer and seller. People always ask, should I be buying premium or should I be selling premium? Well, if you think about this, okay, both the buyer and the seller, they don't necessarily both lose if we end up on the edge. Depends upon the management, okay? But there's no meat left on the bone. And what that effectively means is you have one trading group that says we're going to move 28 bucks. The other trading group says we're not going to move 28 bucks. What do? We move 28 bucks on the button, right on the edge of the line. And what do? We just push to the next week and we keep amplifying size and amplifying size. Why? Because there's less and less edge for the trader. It's too efficient. And when I start to discuss that the marketplace is simply gone, it's just gone too far. Okay, efficiency has gone too far. Okay, there's no edge between what? The implied volatility, okay, and actual and realized volatility. In fact, that's the statement. Actual moves in some cases are actually outpacing implied volatility in many different products. So actual moves outpacing. Now, if you want me to kind of detail this in a couple of different products, we talk about the efficiency trade, let's go look over at the XLF. Now, the XLF, I don't calculate expected moves in here, but instead we have the auto expected moves, okay? Now, what am I talking about? Well, here in the auto expected moves, right on the edge of the expected move. Here's one, just a hair outside of it, okay? Again, right on the edge of the expected move, right on the edge of the expected move. Week in and week out, we're adhering to these edges time and time and time again. No matter how many times I look at this in different products over here, again and again, the efficiency, people, it's everywhere. Algorithms are driving the marketplace. But as algorithms drive the marketplace, they're leaving less and less edge, Okay, they're leaving nothing to the imagination, and that's why I say, and this is a very big warning. When we've gone too far into this efficiency, okay, this actually reminds me of many past years. We've done this before. Listen, we have all seen this movie before, but nothing to the extent that we're currently seeing. And I would actually attribute that, okay, to the idea that in the past, people always like to draw conclusions. Well, I remember back in 1998 when it was this efficient, because we did have a period of incredible efficiency back then. Yeah, well, get this, we have weeklies now, and these weeklies have a Monday, a Wednesday, a Friday expiration. In most cases, this next week, of course, doesn't necessarily have that, but I continue to reiterate that just the weeklies themselves, they've changed the nature of the marketplace with a Monday, a Wednesday, and a Friday expiration. It's creating more efficiency, not only in the SPX, because it's dampening volatility by having more expirations. You know how far the markets are likely to move, okay, between now and Monday. Why? It's not just defined by expected move. People are trading hundreds of millions of dollars. Okay, they're trading billions by the end of the week. Okay, and it's become the self-fulfilling prophecy, not because you draw lines on a screen, but because people are trading the line. Okay, and that line, for instance, for Monday is $15, and it can be seen in, again, almost every single product out there. So this simply means, all right, and I don't want you guys to take this as a negative over here. Right now, I don't want to sell options premium. That's one of the first things that it means. Okay, that doesn't mean because it's too efficient, does it leave no edge for me? The efficiency is all in the short duration. All of these servers and all of these trading firms, they're all worried about sub-second, the here, the now. They don't even care about a week or two from now. It's actually opening up opportunities for us. Okay, the biggest thing that I see is when markets have gone too far in terms of this efficiency trade, when things really start to rip apart and break apart, and they will break apart and rip apart, okay, that's where there's going to be opportunity. And at this point in the game, I still want to be an option premium buyer. I'm going to say that again. I want to be an option premium buyer, or at the very least, I want to use something like in-out spreads, which I'll show you here momentarily. Okay, we're far too efficient. Okay, things, all right, can break in little to no edge. And I want you, again, to remember that little sentence right there. We're far too efficient. Things can break when there's little or no edge. All right, with that, okay, effectively what it means is define risks. Define risks and keep your hands and feet inside the vehicle at all times. I've said that time and time again. By the way, when it comes to that efficiency trade, as I said, I can bring up product after product after product. Even after I bring up something like Apple, you'll see the exact same thing. Any incredibly liquid product, okay, in most cases is really adhering, okay, to their expected moves on a week-to-week basis. Sure, I'm bringing up Apple, which, by the way, has had one of the most stellar moves, okay, of any product. And the reason I'm bringing up Apple over here is to show you we're a hair off expected move. We basically end on it here, hair off of it here, end on it here, end on it here. Here's a move to the downside. Here's a move to the upside, okay? Here's what? A couple of pennies off the expected move, right on the edge, right on the edge. This week is actually a breach, which was interesting. Okay, so here we actually have efficiency starting to effectively break down, but week in and week out, that's Apple. I mean, I can go to, again, product after product after product to show you, all right, this trade is everywhere, all right? There are premium sellers and there are premium buyers, and they are literally drawing a product, okay, right to the edge of expected. And people constantly say, well, how should I trade this? And we've got class after class on that. It's about butterflies. It's about actually pinning the edge of the expected move at the end of any given week. Now, I did want to point out just a quick note on the market as a whole. Not that much happened this week, right? We grind to the upside, a little bit of sell-off here on this Friday. Big reversals, though. Reversals came in Apple and Amazon. Just something to keep in mind. These are fairly wicked reversals. I mean, this is an all-out, okay, blitz in terms of algorithms. In fact, you can see the algos going totally nuts in here. In fact, one of the other things, when I say the algos are totally nuts, is the volume bursts in there. This is 1 minute candles. The other thing I like to point out with algorithms, only algorithms can make moves that are that linear. I mean, there's incredible. Okay, again, how efficient algos have become in here. Very, very similar instance inside of none other than Amazon. Amazon also seeing a bit of a reversal on the trading session after being up, to 1900. It backed off some $30, ending the market massively unchanged on the trading session. Nevertheless, Amazon backing off, it actually sucked the Nasdaq underwater and allowed the S&Ps to sell off just a few points over here. But when you have two of your monsters of tech that have actually broken out a bit to the upside, and again, I wanted to show you both Apple, broke out to the upside in a big way yesterday, as did, of course, Amazon. Amazon had a wild breach of its expected move. So this could actually be the beginning, if you will, of when I was talking about the efficiency trade. That, people, that's inefficiency in one of the most liquid products out there. What do you see in Apple? Very, very similar. Total inefficiency. So as I said, keep your hands and feet inside of the vehicle. Now, bullish and bearish positions. One of the questions I'm getting a lot of, what do you do in a time like this? In a time like this when the marketplace is just rallying straight up, right? Turn off all the expected moves. Let's push aside for a second efficiency or inefficiency in the marketplace. The marketplace has been rallying up. It's like a freight train to the upside. Listen, you want to get bullish, you want to get bearish. Last weekend's video, I talked about you being bullish or bearish or hedging using deep in the money options, right? Just deep in the money, really short-term options. Feel free to look back at that last weekend's video if you need any more details on that one. But let me give you another idea here, And I'm going to give you an idea specifically inside of the spiders. All right, in the spiders, I don't want you guys to think I have every trade he's got on is bearish. Absolutely, unequivocally, no. This happens to be none other than a ratio back spread in here. In this ratio back spread, I had initially, sold. Again, I sold one of the 316s. I bought one, two, of the 320s. This one's trading now for over. And again, this is if I bought it. Right now, I'm ready to sell it. So if I wanted to unload it, it's over a $2 credit. Use ratio back spreads if you want to get bullish. I want to reiterate that. Use ratio back spreads. Again, this is a back spread that I had on that's now fully in the money. It's a profitable trade. So if I wanted a short-term bullish trade because I'm looking for a burst to the upside inside of the marketplace, let's say that you just wanted to do it for about 2 weeks out, Don't get cute. Use the skew to your advantage. Where's the skew? All right. If you look at the implied volatility, the at-the-money call is trading for close to 10%. Slightly out of the money is trading for like 8.76. What do? I sell the higher implied volatility, sell the higher implied volatility. Sell it one time. And for example, buy 1, 2 of the lower implied volatility. Here's for a 43-cent credit. Now, clearly, the marketplace has to explode to the upside over here. I mean, you're going to need to move clear out to like 330. But is it capable of doing that? Sure. In a marketplace that if you think a blow off top is coming, right, just use a very straightforward ratio back spread. Don't get cute. Short duration can be very, very effective. Again, short duration can be very effective, but we have to have a staggeringly large move to the upside, 330, to make this one really start to work, which is an $8 move, which is outpacing the expected move. Remember, as I said a minute ago, markets have gone too far. The efficiency trade is in play. It doesn't mean, though, that we can't get wildly bullish to the upside, And all we have to do for you to make money in that ratio back spread is we have to smoke through the expected move to the upside in sometime in the next 2 weeks. Very possible, very plausible. Now, if you wanted to get bearish, once again, don't get cute, people. Use the skew to your favor. Now, here you can go a little further out in time, right? Go some 31 days out. When I say use the skew to your favor, use like an in-out spread. Here we are trading what? 322 and change. Maybe use a 324. There's the 324. Sell, for instance, the 322s. Do you realize that this is a $2 wide spread for a 76-cent debit? But the 324 puts, they're already in the money by $1.15, but you can buy the entire spread for 76 cents. Why? Because the skew. All right, the skew is with you. Listen, you're buying a 9% vol and you're selling a 9.8 vol. It may not look like a big differential, but a 0.8 vol differential is enough to give you what? A nice little edge getting into the trade. Again, ratio call back spreads if you want to get bullish. Buy in-out put spreads if you effectively want to get bearish. As always, there's a tremendous amount to think about coming into the new year of trade. Don't get caught up in all the, 2020, it's going to be the year of this. Listen, Every year for over 20 years now, I've heard what everybody's take on the market's going to be for 2020. Okay. Right now and right here, it's all about this efficiency trade. When you have a marketplace that's gone this far, there's no easy coming back. All right. There's no easy way out of a marketplace that keeps moving to the edge without, of course, breaking apart. Look for efficiency in 2020 to turn into inefficiency. Look for wild and outsized moves. Be a net buyer you want to be, again, net buyer of premium, long gamma. Thanks everybody for joining us here at TheoTrade. Have a wonderful new year and a wonderful weekend. Bye-bye.